So there we go. All right. I see some folks still logging in. Awesome. All right, so let's get to it. We got a lot to cover. Super excited that you all can be here with us. We have some interesting markets that we're dealing with. So the timing could not be better. So let's get to it. Yeah. So I'm super stoked to share how ETFs are going to change your trading life, from watch list building to the best symbols to focus on, to trends, to chop, when to get in, when to get out. We have a ton to cover. So let's dive in. So why are we here tonight? We could talk about 2020, but 2021 is a very different market. It's been a different beast. And once again, it's changing on us again, right? Gone are the days of riding one big wave after the other. 2021 has had moments of frustration. It's had moments of nice trends, but once again, we're seeing what's happening when a market decides that there's confusion, there's panic. So whether it be chop, false breakouts, and how many of you experienced this year? Lack of trends that have without the follow through. We've had a lot to survive this year. And we're going to get into why we can do more than just survive these markets, but how we can thrive in these markets as well. Why are we feeling frustrated this year? Maybe even more specifically now. And I mean, just in the last handful of trading sessions, it's difficult to know where to look. It's difficult to know what to trade and get the kind of results that maybe we've been used to. Where to get into the trade, where to take profits, meaning where to get out. This has been really very much a trader's market. In other words, having that constant adaptability. And if there's a topic that's too often overlooked, it is those exits. And we'll talk about a lot about this as we go through. So keep in mind, even though we're talking about this year in 2021, these are the tools, these are the processes, this is the mindset that I've used up until this point for the past 3 decades. And it's going to hopefully what I'm going to be doing for the next 3 decades of my trading, of our trading. So I love this slide. This says so much. So why ETFs? Of all the things we could talk about the markets, why ETFs? How did this even begin as far as a way to look at the market and an edge that I feel I continue to benefit from even now? Why the shift? So how many of you remember what 2008 felt like? Not what it looked like, what it felt like, right? Personally, professionally, your accounts, right? The markets are rolling over, but they just weren't rolling over, were they? Right? We had downtrends, we had fear, we had sort of this scale that we had never really felt before. A lot of you, I felt it. I mean, I remember feeling like, and I had buddies on Wall Street tell me, yeah, we're looking at pushing ATM cards into the ATM and not getting them back. You might remember GE couldn't get loans, and these people make light bulbs, right? So I was managing my, and like a lot of you, I was managing my trading account, but I was also managing my family's money. But 4 accounts at the time, 4 portfolios, and I did not know what to do. So in all that emotion, I kind of had to go through it like a lot of us did, but we saw our way out of it, right? The way that I saw my way out of the 2008 doom, gloom, panic, oh my gosh, this is all over, was ETFs. I found an article that got my attention, and that's where the clarity started to come. That's where the peace and the plan came. The article that I read talked about mutual funds. And actually, what was really interesting is they were talking about mutual funds losing their luster. And then there was this new growing thing called exchange traded funds, ETFs. And we could trade them electronically. We could trade them through our platforms, trade them, right? And so they were lower cost. We had better access. And I don't have to wait for the closing price to actually put a trade on or buy or sell them. It caught my attention. So that got my attention at first. Then the trader in me realized I found the best way to rebuild my trading account. I would follow the flows in this increasingly, remember, this is 08, 08, 09, 2010. I would increase the flows in this market that was rapidly growing in popularity because I got to understand what the ETFs were telling me at a very granular level in stocks. It was X-ray vision. So I could understand what was happening at a broader level in different niche markets and sectors, but it gave me insight into the indices. It gave me insight into where the interest was in the market. So it wasn't that I was in love with ETFs alone. It was what they empowered me to understand about the market. So keep that in mind. We're going to talk about ETFs, sure, not just ETFs, but ETFs in many ways as a way to understand why the market's doing what it's doing, whether it's chopping, strengthening, weakening, right? So the way this came together is I realized I had a major problem in my hands. I need to deploy capital. I had gone to cash at a certain point, as many of us did back during the financial crisis, and I didn't really understand how to get back into the market. I was looking for a trend. I was looking for a way to put money in the market where I wouldn't be alone. Now, what does that mean? I was looking for ways where I knew I would be able to surf, in many ways, big volume, institutional volume, that flow, right? And the solution was the ETF. That's what was going to allow me to understand which little corners of the market were getting attention and the volume, the money, right? So once I realized what the ETFs revealed about the market, and in a way that was kind of stealthy, I kind of kept this to myself for a minute, right? Most people don't know what to look at because they're looking at individual stocks or they're looking at the indices, the S&P, the Dow, the NASDAQ. But in the middle are these sectors, and in the middle are these ETFs. So I knew I had an edge. It's the same edge I'm going to share with you tonight. It's the same edge that I've been using since basically 08. And I've been pushing that edge, been benefiting from that edge for over 12 years. So in 08, we had a problem. I didn't know how to, find my way out of that darkness. How many of you have looked at the charts and you just can't find the trade, right? So this is the way I saw myself out of that darkness. It was the ETF. So I'm really passionate about these for what they allow us to do as traders, okay? So what are some of the things that I've learned from that massive U-turn that I made? I didn't need Greeks, didn't need home runs, got to be patient. And everything came together when I realized that a small number of stocks could and actually were moving the broader markets around, right? That's something called high concentration weighting. And we'll talk more about that. I realized this in 08, and a lot of folks are realizing this now, but actually not as many as you think. A lot of folks are overlooking some of the things we're going to talk about. So what do we want? We want steady P&L year after year, right? That's the bottom line. I mean, why are we here at the end of the day? Why are we here? Quite literally at the end of our day, right? This is what I want to show you, how we can do this year in and year out. So proofs in the pudding. This is, and of all the things on this chart, I want you to look frankly at this. I love this graph. Okay, this is what everything boils down to here. All right. What this is, the way that I want to present this to you, that line right there is 0. Do I lose? Yeah, I actually lose quite a bit, and usually in clumps. See that? We lose as traders, but we don't want to lose our shirt. What we want to remember is if we keep this losses small, we can always come back from them. We want, of course, our winners, which are all these above the 0 line, to outnumber our losers. But we can't get the losers. We can't give them too much leeway. We can't let them grow in numbers, clearly, because otherwise we're going to blow up our accounts. But it's steady profitability that we're after. Singles and doubles. A lot of you have seen me show charts like this before. And the run continues because we're sticking with a process that allows us to understand where the trends, and sometimes as we walk into this market now, where the non-trending action may be, where the opportunities are, and how we can control risk. I mean, that is what this wingman shows you. Not what I've made, but the risk that we can control. All right, so we always start off looking for a trend. That's Even in this market now, believe it or not, there are trends in this market. Even when it looks like the indices are getting choppy, there are trends in this market. So we always start by looking for a trend. This is the foundation of all my great trades. By the way, this is the foundation for all the greats out there in the markets, whether you're reading New Market Wizards, the greats follow trends. Why not just follow in their footsteps? Yeah. A trend and the patience for waiting for that pullback when I find it. Now, some of you might say, Rog, this isn't a pullback market. There are places we can take advantage of chop. We'll get there, but there are still trends. And most traders have difficulty finding the trend. They get in too late, or they can't differentiate from a good trend compared to a weak trend, right? This is the edge that I get from the wave and the grab candles. These are the color-coded candles and the moving averages on my screen here. The color-coded candles make it simple to see a trend and trust that healthy trends correct, right? And frankly, that's what I did on the Dow. Let's get our handy dandy writing tool out here. That's quite frankly what I did on the Dow using DIA, doing the DIA ETF on March 25. Now, these were trending markets, right? We'll talk about how we manage things even when they're not trending, but this is a perfect example of buying a dip, right? And I know that might be very maligned right now, but it works when you think about the span of your career, not a specific month or a specific year, your entire career. Buying and getting out of the way of a trend is what has worked for me. And it will again, all right? So much so that we can scale out, in this case, at 2 profit targets. And I can pay myself as the green grab candles persisted. As I like to say, surf the wave, right? 67% return, not too shabby. You can see what we did on this DIA trade. So while some traders may shy away from trading futures overnight, because I talk to a lot of futures traders too, one of the easiest ways to manage that risk is with the ETF of the Dow. So if you're a futures trader out there thinking, yeah, Rog, I day trade futures, right? But I don't want to take them overnight. Think about what you're leaving on the table. And if the reason is it's cost prohibitive, one thing we're going to talk about throughout the evening is how affordable ETFs are to trade, how they can make seemingly unaffordable positions very much within your grasp in terms of your budget and your account size, large or small, all right? So here's another trade. In this case, one of the things, unfortunately, a lot of traders will do is overlook sector ETFs in favor of an individual stock. In this case, we're looking at XLC. Traders might be looking at, say, Facebook or Google, which are not inexpensive to trade, in lieu of the ETF where they're heavily weighted. Sector ETFs give us access to a specific group of stocks that have a related narrative. So sometimes the problem is, I can't trade Facebook. It's too expensive, or I can't afford Google. It's too much risk. But we have this XLC, which is conveniently heavily weighted in both those names. And if we want to be specifically taking advantage of these names, we've got a ready-made sector ETF that allows us to do so. So if there's anything that the sort of buy anything markets of 2020 taught us, is sadly a bad habit, thinking too broadly. All right. Now, if you can remember that the market's not always going to be as generous as 2020, and that thinking too specifically to an individual stock, right, either at the index level or an individual stock, can leave you either with a very diluted look at the market, the index, or a very binary, I'm right or I'm wrong trade, right? It works or it doesn't. Sectors give you a margin of error, right? As well as the ability to take advantage of a specific, in this case, the communications corner of the market. So in this trade, XLC was a relative outperformer. It was the best corner of the NASDAQ for a really long time. So not only did I say, you know what, it makes no sense to trade the Qs. It makes more sense to focus on the clarity we're seeing in communications. It was more affordable, right? It was a more affordable way to go into the options in XLC than to pull some sort of multi-leg option acrobatics, getting into different option strategies. This was a straight up long call. XLC allowing me to benefit from the strength in Alphabet and Facebook, And it was actually one of the stronger uptrends of this year, right? 126% return. Not because of XLC, but because of ETFs. I knew where to look and I found the relative outperformance because I had the ability to grab the very best corner of the market. All right. So a lot of traders don't realize that there's a number of commodities, right? So we take a look at ETFs like the DIA, SPY, QQQ, but then we know we can look at sectors. Now we can trade commodities. Okay. So there's a number of commodities that have ETF alternatives. And I even recommend a lot of these to my futures traders because it ends up offering a less expensive, more affordable sort of choose your own adventure into markets like, well, there's no uranium futures. So this is a trade in uranium. Uranium options via the URA. Love, love, love this market. It's actually an interesting one again right now. This was back when we had the strong reflation or inflation narrative. There was a tremendous demand narrative. There was a strong seasonal cycle. And these commodity ETFs are excellent candidates for those kinds of trend following trades. By the way, there's still a trend in URA. It's actually reorganized. So those trends are still in the market. Just got to know where to look, right? We waited for the dip. We bought calls, rinse and repeat. All right. So in this case, you add to the fact that, take a look at the cost of this thing. $185. Very inexpensive calls, which on a dip cost less on average as we surfed this wave, on average cost less than $200 per option. So now you have, and keep this in mind, scalable, right? You have a very scalable trade setup for any size account. Liquid market, small account, buy 2, buy 4. Large account, buy 20, buy 40, right? It's scalable. URA is also a really great example of a clean visual, right? Meaning the wave and the grab candles are doing their job, using color to confirm what the market is doing. All right. I've been using I created this back in my 20s, this wave, just putting together a very specific moving average to understand where dynamic support and resistance are. And I've been using this thing for over 3 decades. And what it's going to do for you is decode trends, but also show you where those dips are waiting. Really great trade. And one of the things that I want to mention as we're going through the presentation is, there's lots of varying size here. So, $20, $185 options. Ask yourself, crunch the numbers on that. That's less than $2,000. You can scale with this, right? You can absolutely scale with this. All right, so let's move on here. Another view of uranium. And here's the lesson here. You don't have to waste your time looking for new symbols. I think a lot of times we as traders get stuck in that scanning sort of rabbit hole of constantly looking for new symbols. If something's working well, stick with the trend that has good structure. One of the problems a lot of traders have is, not having enough time to find great trades. Sticking with trades that are working and using ETFs to find the corner of the market keeps your trading watch list building process quick and easier, right? So that's a big problem a lot of traders have. What the heck am I going to trade? Well, in this case, stick with a trend that has good structure. So in this case, we re-entered the market. Now, sometimes traders will re-enter markets because they just finished losing. It's kind of a revenge trade, right? Who's been there? I know I have, right? But in this case, we want to re-enter markets when they continue to produce for us, not the I'll get my money back revenge reentry, but let's keep making money with this. Let's keep sticking with this, with what's working until it stops, right? This is the mindset of world-class trend followers. So the common misconception is often that the best and biggest traders are able to find these major turning points in the market, right? These unicorn picking the top or picking the bottom entries. And that's actually not true. Front running these eventual rollovers, but assuming we know where they are, is more often than not going to cost you a lot of money or sometimes even your account. It is painful to be wrong in a trend with this kind of low probability attempt to pick the top or bottom of a trend. Instead, be chill, be cool, be a surfer. There's a reason I call my indicator the wave, not to mention I used to love skipping senior year high school to go surfing around here. Stick with the wave until it takes you to shore, right? That's the mindset. So as we saw this trend go from February 1 to June 17, there were only 2 red grab candles. Plenty of reason to stick with the trend. All right. So now think of this. I've done this now twice. We showed you the previous trade and we did it again, right? We stuck with URA. Now, we always know stick with the trend until it ends. Okay. This is something every trend trader has to accept. And that is there is one last trend trade. Don't be scared of it. Let's talk about why. There's always going to be one last trend trade, but to trade in fear of that eventual loss will cause you to miss out on good trades. Now, let's think about this for a moment. Just in the 2 examples that I've shown you here, 1,500, let's average out, 1,500, 4,200, right? And this is a $450 loss. This was the one last trend trade. Exits are so important. Profit targets, of course, but stops as well. If I look at the overall trend that I surfed in URA, multiple entries, multiple wins, when it finally rolled over and the wave was broken, we have a nice visual of the shift, the break of the wave, the second red grab candle, right? Losses are never personal. The market's not out to get you. It really isn't. Most of the time, it doesn't even know you're there any more than the ocean knows a surfer is riding the wave, right? So when the cost is low and your position size correct, the loss is easier to take, right? In this case, the $1.90 calls, 168, $450 loss after we did about 1,500 and 4,200 in profits. Do you think I mind less than 10%? Not even a little bit. That's how trend trading should work. And that's how the one last trend trade works. It's a loss, right? It's one of those little dots below the zero line of that group of trades that I showed you from this year. Okay, so if you're already starting to see that ETFs are a game changer, they're going to help you watch list build. They're going to help you focus on the best corners of the market. They're going to give you access to markets that you may not get otherwise, like uranium, right? They're a game changer. They offer a cost-effective approach. Think about the cost of the options that I just showed you in those examples, right? No Greeks. Not that there's anything wrong with them, but it's okay to keep trading simple. I think we've all gone through the process in our careers of thinking as we trade longer and longer, we have to make things more complex. I will tell you this. Into now my 3rd decade of trading, 30 plus years, I trade more simply now than I did 10 years ago, than I did 20 years ago. It's really been a whittling away process. I'm not scanning hundreds of symbols like I used to. I don't have to. ETFs or why, right? So what are your reasons? What are your reasons for wanting to simplify your trading? What are your reasons? Time? Maybe you think to yourself, right? What are your reasons to spend less? I think it's great to have a scalable approach. We all start with small accounts sometimes, but we want to grow them, don't we? ETFs. We all want to be able to access markets like Facebook and Google, but maybe in the early part of our career, we can't, right? ETFs. So I do want to take a moment, and this is kind of a little bit of an aside, because we get this question a lot when it comes to ETFs. And that is, what is this stinking sector rotation stuff? Why does everyone talk about this? So before we go looking for great ETF trades, we need to understand a little bit about sector rotation and why ETFs probably explain this better than anything else, quite frankly. All right. So sector rotation is kind of some techno babble. And I want to explain to you how we decode that with ETFs. All right. A lot of sector rotation is really confused with participation. And what that means is when you look at the way in which different sectors move, there's usually a give and take. We know discretionary versus staples. We know utilities, bonds, gold versus tech and high beta, high momentum names, right? But the way you can avoid the fear mongering that the media loves to, make us tune in and stay glued to the television, right? The way you overcome that fear mongering media, the way you overcome the idea that, oh my gosh, big losses are coming, another market's in turmoil special, whatever it may be. It's just understanding that within the S&P, within the NASDAQ, however you trade it, SPY, QQQ, we have sectors. And before this thing rolls over, we're going to see those sectors start to behave in a very specific way. So sector rotation, what is it? It's like a Ferris wheel, right? Some sectors at the top view, others at the bottom, but the Ferris wheel is always rotating, right? Kind of like one sector is preferable to another. So the money flows there for a little while, right? And then the money flows out of another one. And if you can see that, and the only way, frankly, you can see that is by using ETFs. If you can see that, now you can start to see that rhythm, right? You're not now scared of this sector rotation that's going to crush your account, right? And the reason is you've got high concentration weighted stocks in these heavily weighted sectors inside the broader indices. It's like X-ray vision, okay? I got to put a cat, you guys know, those of you that are in the chat rooms with me, my cat's hanging out with me a lot, although that's not my cat. My cat would never allow me to do that. I wish he would, right? How do I know which ETF to look at? Follow the ETF sectors. Look at all the heavily weighted sectors in the NASDAQ, S&P, Dow. That's where the X-ray vision is, right? We're able to see inside the broader index where the strength and weakness is, not just for great trading, but also for our sanity, right? When we're hearing one message from a lot of folks looking at the market and we're saying, wait a minute, what's really happening? So you can see it for yourself, right? So this is where you get forewarned. This is where you can inform yourself about, oh, wait a minute. Yeah, I'm seeing healthcare do this and I'm seeing communications do that. And what is that telling me about the markets, right? So this can only be done at the sector level. So you can avoid the chaos, the turmoil, the panic, and you don't have to engage in all that because you can look at what's happening inside the index and even what's happening inside an ETF. All right. So just a little, this is, again, one of the many reasons I love ETFs and why they've been such a big part of my life since '08. So what about the short side of the market? We talked about long, right? We know there's chop coming. It's here. But what about the short side of the market? Can we use the wave and grab and the Darvis? Darvis is my automated support and resistance tool. You see it running here on this chart. Nothing on this chart has been drawn in manually. I'm just reading the dashboard, okay? So in this case, these arrows are our updated Darvis 3.0. How many of you know about Nicholas Darvis? A lot. He's got an unbelievably inspirational story. He's a dancer, got paid in stock, put the stock in a drawer, pulled the stock out later on, I believe it was Canadian Railway stock, and realized that it increased in value. That's sort of the short cliff note story, right? And then he realized there's real money to be made in the markets. By the way, did you know that Nicholas Darvis, he's the one that wrote How I Made $2 Million in the Stock Market? He didn't intraday trade. He traded at the end of the day. And in many ways, he was a trend follower, right? Real legend in the markets. Well, we've modernized the Darvis. Basically, we decoded what the Darvis box is and said, wait a minute, markets are different than they were in the 1960s, but the logic and the wisdom of Darvis still prevails. We can modernize this. So I have the wave, the grab, the Darvis on this chart. How do we trade downtrends, right? It's pretty darn simple. Long puts, right? We look for the right structure. Thank you, JT multi-trend. Okay, this is studying specific moving averages that solve the problem of telling us, is the market moving higher? Is it neutral or is it moving lower, right? So just as there is buy the dip, you can also sell the rip. And you can buy puts with the bounce into the wave, just like we did the dips, right? You can do the rips. Downtrends, though, tend to be more volatile and sudden compared to uptrends. So they're not necessarily as equally organized, okay? Panic is a very swift emotion. We know this. By waiting for the best timing to buy the puts, the cost and the risk are simultaneously lower, much like the other way around when we buy the dips. So This is a bearish environment. We're using the grab candles. We're using the JT multi to confirm that. I personally prefer downtrends. Gravity applies. We just don't have that many well-structured, well-confirmed downtrends as often, really, in the last couple of years. But if we get it, if we have a downtrend, not only will these tools allow us to see it, because now we've got the ETFs that will show sort of maybe this crumbling edifice of support. It'll allow us to see via the grab candles and the structure. We're not going to be broadsided by this. It also means I don't have to jump the gun. A lot of traders are jumping the gun before the structure is there. Trade what we see. So if the market rolls over, no problem, bring it. By the way, I kind of hope we do. I'm not saying we will, but I kind of hope we do. Because in 2020, my best month was March. That was the month that you know what hit the fan. So believe me, if we get that downtrend, I will definitely be leading the battle cry on that one. We just haven't seen them as often, right? So, I think a lot of traders want to front run the trend shift. It's a siren call that a lot cannot resist. I get it. An entire movie was dedicated to The Big Short, right? The entire movie was dedicated to some folks that front ran a massive move. And it's sort of romanticized something that is actually a very hazardous way to trade, unfortunately, right? But when you have color-coded indicators that are objective, simple to read, you can relax knowing that the downtrend is not suddenly going to elude us, right? In this gold trade, $495 puts yielded nearly $1,000 per option, right? Gotta love gravity, 2x winner. So, rest assured, if we see that gravity, we're going to grab it. I love this image. It always makes me laugh. This is actually a Brazilian actress from one of the soap operas down there. I love this image. It just makes me laugh. So taking profits. Right now, we've talked about finding the right ETF, the right trends, the right setup, right? Understanding the indicators, the actionable and appropriate price levels, lowering risk through lower cost options. I cannot emphasize that enough. That's such a powerful way to control risk and make the markets more accessible to more folks. Scalable as well, right? We've talked about how the trades worked out. There's a missing piece, and I get this a lot. And that is, right? This is the perplexing part of it for a lot of traders. How do we know when to get out of the trade? In other words, profit targets. How do we know when to get out of the trade? Because the truth of the matter is, we really don't have a winning trade until it's a realized win, until we close a portion of the trade out, okay? So, as I like to say, we pay ourselves while we can, not when we have to, all right? So, the truth is trends are going to take a breather. This is the trend in the USO. By the way, there are trends in crude oil right now. The trend in crude oil. If you're looking for something to look at tomorrow, take a look at crude. Take a look at crude stocks. It's definitely been reinvigorated, but it was very good to us earlier in the year too. So trends will take a breather from time to time. After a very strong run up in late last year, December 2020, to about March, right, mid-March this year, crude did just that, kind of took a breath, right? You can see that just lost its really nice uptrend, and it took a breath. And this is where the wheels fall off the wagon for a lot of traders. This is a common mistake that a lot of traders make, is they look at the market as either this is going up or this is going down. Very binary. Okay, this must be a downtrend now. Wrong, right? Very wrong. Charles Dow taught us more than 140 years ago, there are 4 market behaviors, okay? So in other words, this very binary way of looking at market behavior causes losses, and this is so important. Continuation. Again, I don't want ever to just talk about what the markets are doing right now, but rather how you can get the knowledge to trade every kind of market for the rest of your career, because it should be universal and robust, which is system speak for it works really well and it works on everything. We're trading market psychology, which is to say we're trading the psychology of market participants. Continuation is a far more common psychological reaction than capitulation. In other words, continuations happen more often than reversals. We just remember the reversals because they're rather traumatic, but they're not high probability. So whether you're a trend follower or whether you like momentum breakouts, these pauses in the trend are unbelievably helpful. They're powerful because if you know how to recognize them, the grab candles do it for us. This was actually setting up going into April for another leg higher. Again, trusting that the markets have a higher probability of continuing. And that's exactly what happened, right? Note the red grab candles could, in this case, couldn't quite get the traction that the bears needed. In other words, the organization of bearishness, while it kept kind of flickering on, right? It would kind of get some traction and lose traction, kind of get traction, lose traction. That's not the kind of market we want to short. In fact, that's the kind of market we want to fade, right? It opened the door for some very low cost options with plenty of time. Those are two of my favorite things. Inexpensive options with plenty of time to expiration. These were $260 calls that were ultimately closed out for $710 each. So $260 to $710. Again, each. Again, think how many options, if very affordable, $260, that you could buy. And all of this was possible because we knew to respect the trend that was. That continuation is far more common than capitulation. Now, that's all great, Rog. How did you get out of the trade? I get where you got in. We've been talking about this, but how'd you get out? Okay, this is where it gets really cool. Markets are moving higher, and I'm getting these propulsion dots. And we haven't talked about propulsion yet. We've talked about wave, grab. We've talked about the JT multi. We've even talked about automated support and resistance, right? If you knew there was resistance waiting at a level, do you think that might be a really good place to place a target? If you knew that propulsion was akin to understanding the market's foot on the accelerator, and those dots disappeared, those dots are called propulsion, those dots disappeared, there could be a chance the markets are getting ready to move lower. Take a look here and then here again. Disappeared, disappeared. What happened to the market? Rolled over. Disappeared. What happened to the markets? Rolled over. Propulsion could have been called the accelerator pedal, and maybe that would have been a much more fun descriptive name. But what they're telling you, and we have three kinds, it's kind of like low gear, medium gear, and high gear. We can kind of understand incrementally if the market's taking its foot off the gas pedal. That kind of indication, again, color-coded, dots. Can you count dots? Can you see if there's a bunch of them, one after the other in a row? That's what I use to understand if the market trend and momentum is waning. Okay, just that simple. All right, let's take a look at another example. This was a trade in the XLB, an ETF, basic materials. Now, what's really cool, if I want to take a look at basic materials, for example, I can look at the stocks within XLB and try to find names that maybe I want to trade in lieu of the ETF. If there are enough stocks that look really good within the ETF, rather than the high expense of trading a lot of the names within it and potentially the higher risk, I can trade the group. This is kind of what I call the boat and tides, right? So the point at which the JT multi goes double green, which you see right in here, was double green back in here too. The point at which it goes double green, which is when both the rows, upper and lower, are green, is the easiest confirmation, in many ways the most conservative confirmation of a trend. All right. Now, while we can also use the grab candles and these propulsion dots, there's a pattern there that often allows us to grab a more aggressive kind of jump into that trend a little earlier, sometimes before the JT. So we have two ways to identify the trends. The XLB didn't give me that pattern, so I stuck with the conservative JT multi, right? So we know there's another way we can do this to be a little bit more aggressive. The power in knowing the precise date that the market turns into a trend or goes into chop, like right here, gives us an edge that most traders won't even see. They don't know. Most of them are not looking at market trends. They're not saying, hey, this is what an uptrend needs to be doing. This is what chop does, right? So you already have an edge just by embracing over 100-year-old wisdom from Charles Dow, right? We can use this to our advantage. Right? I love seeing things that other traders aren't seeing. So we use this to our advantage, and we use setups that other traders just simply wouldn't see. So once a trade is obvious, it starts to move. We usually like to get in before that point, right? Getting in before it's obvious gives us a more inexpensive entry into the option as opposed to a more expensive one, right? I like them. I call them blue light specials, right? I'm a child of the 70s and 80s. That's my favorite way to get in. Good old blue light special. Something is on sale, right? Not that it's just cheap, but it's on sale. Something of value is on sale because it's chronic overpaying of an option. That's one of the reasons a lot of traders slowly, insidiously blow up their accounts. It's like slow acting poison, right? But it can be avoided. The dip on the 23rd of March, right in here, right, was such a blue light special. That dip on the 23rd of March was such a blue light special. And while the candle was blue, which it doesn't have to be, but how cool is that? It made the setup, in this case, all the more affordable. $255 in, right? 603 out. So better than a 2X, right? And then we ride the green grab candles, 136% return. How do we get out? We talked about the in. Let's pay ourselves what we can, not when we have to. Take a peek. When did the market let off the gas pedal? We just got in, right? We just got in on the dip. So I know the market's going to need a moment to accelerate. And now it's just accelerating. Ride it, right? This is a market accelerating. Foot on the gas pedal, foot on the gas. Oh, wait a minute. Red stopped, yellow stopped, green stopped. Yeah, the market went up a little bit more for a little while. And then it did this. Pay ourselves while we can, not when we have to. It means that we want to grab the bulk of the profit. We know that we're not picking the top. We know that we're not picking the bottom. We're going to get that really good meaty part in between. Grab candles, propulsion dots. Now, let's say you missed the propulsion dots. Or let's say you said, Rog, it's kind of lingering, but then the red turned on. And that red grab candle was your last warning. The grab candle said, look, or the propulsion dot said, look, I know you didn't listen to me. That's okay. But my buddy, the red grab candles are now telling you, get out, pay yourself. It's been a great ride, right? So that's the way we can read what these indicators are telling us. That's how we automate a lot of our process, okay? Okay, again, emphasis being on paying yourself while you can, not when you have to. Now, of course, we know trends are susceptible to pauses, but pauses are not reversals. They're not even high probability reversals. We're dealing with one of those situations right now, where we're kind of sitting at the market, looking at the markets thinking, is this the beginning of a downtrend? Maybe a massive one at that, right? Well, the XLE is kind of a good way to look at what we're dealing with right now. Really nice uptrend, pull back pretty harshly, chopping around, went back higher, right? This is not that dissimilar to sort of the confusion that we're dealing with at the moment. Again, if you find a sort of an evergreen approach to the market, you're not curve fitting to what the market's doing now. You're asking yourself, do I have an approach that is going to allow me to follow trends, recognize when trends are broken, and shift to a different type of strategy if the markets chop or turn into a downtrend? In this case, XLE paused for 8 sessions before resuming the trend. Knowing how to confirm session after session the validity of a position makes all the difference between a loss and a win, right? Can I look at the markets on Monday? Ask myself if that trade is valid. Can I look at my indicators and look at the market on Wednesday, Monday, Tuesday, Wednesday, and just keep validating it so I know when to be patient, all right? Consolidations inside trends, once again, whether you're a trend follower or you like momentum breakouts, are fantastic, and you can be pre-positioned, which is to say, if you know the trend was up before and continuations are likely, the way that you can position yourself is very advantageous to traders who contrast that, right? Who are thinking, oh, this is the precursor to a market moving lower. And you can only do this when you have the confidence of directional bias, which we have with the grab candles, with the JT multi, right? Even with some of the propulsion dots. So the XLE is actually a really effective way, cost-effective, to trade and risk Exxon and Chevron. right? At the same time, these are the number one and numbers two stocks. It's a high concentration weighted ETF, and this is about 23.5% weighting, and this is 21.5%. So of all the stocks in XLE, these two are what? 45%. That's high concentration weighting, by the way. This is such an advantage to traders to have this high concentration weighting understanding. So playing both these stocks would be kind of expensive. And it would be a lot more moving parts, right? But it's made really affordable by trading the calls, as you can see here in XLE. Now, in a case like this, when things are a little bit more choppy, we wait for the market's got choppy here. The trend that preceded was up. We got long, okay? Red dot stopped, but the yellows are still going. The green stopped. That's a great place to pay yourself. Granted, we didn't move lower, but we kind of stalled out for a little while. And the market went up again. Now, what's really great, and this is the scalability that I talked about earlier. You might say, oh, Rog, we got flat here. We don't. When you have, and see how I exited over the course of 2 levels? Because when we have inexpensive options, we have the luxury. How many times have you bought an option and it was so darn expensive, you could only buy 1, maybe 2 of them? And then you ended up managing it in the worst possible way because you didn't want to get flat. Because, well, what if the market keeps going? We don't have to worry about that with the scalability of these ETFs. So I take some profit, but then the market still is valid, right? Session by session, I can confirm, grab candles, the JT multi, right? And then it popped up again. Cool. The dots turned on. I have some resistance in this area. The dots stopped. Resistance and dots. I pay myself again, right? So the whole idea is to avoid that. The whole idea is to avoid that, right? That if we are able to note the small, sometimes it's nuanced, right? But if we can note those small cues, we have an opportunity to pay ourselves what we can, not when we have to, and take a $2.90 option to maybe $3.90, and then to $4.90. And because it's so inexpensive, super scalable. Buy 10 of them, buy 20 of them. Very liquid market, right? Okay. So again, with the emphasis of paying yourself while you can, not when you have to. I mean, there are trades we know we want to take. And a lot of times they look like uptrends that never seem to want to retrace, right? They just go parabolic. They run away without us. They don't give us pullbacks so we can jump in. And uptrends, while they are absolutely the best market for the largest group of traders, which is why we say you want to prioritize them, there are occasionally trends that trigger the most impatience, because when they don't pull back, that FOMO, that fear of missing out monster, rears its ugly, ugly head. In this case, financials were trending really strongly February into March, not a single stinking pullback, right? But I know I've got to wait. I've got to wait. I got to, manage my risk first, not start counting dollars I could be making. A lot of us do that, and that gets us in a lot of trouble. Then from March 18 to March 23, finally, financials pull back. That's the opportunity. I didn't presume a pullback was a precursor to a reversal. I realized that healthy trends pull back, right? And look, I know that a lot of us want to be first, get in the trade before everybody else, but look, that's a losing ego-driven trade. We need to bench the ego because it will cost us a lot of money in trading. So I avoid that FOMO monster by waiting for a setup. Now, you don't get brownie points for bravado in trading, right? Being first really isn't helpful. The reason we have the tools that we have, the reason that we use ETFs is to understand the flows so that our trading ideas have company, that there's lots of other money flowing in the same direction, like a surfer, right? What's the point of paddling into the ocean if there's no waves? We need something to ride. And in this case, for us, it's money and volume. So the JT multi have been strongly double green, right? My 8, 13, 21, 34. That means the path of least resistance is higher. And that pullback buys will work. That's the buy the dip. By the way, you flip it around, double red, there's your sell the rip. So we're well equipped for downtrends if they come, right? Saw further confirmation from the Darvas 3.0. and start looking at the dots. Just that it. It's just that easy. Again, when we have strong trends, the way that we exit winners, much like we talked about earlier with the previous example, is scaling out, not just getting flat at the first target. Sometimes I'll have targets that are 2, 3, 4, 5 times winners. In other words, well, natural gas is a really good example. That thing is right now is 9 or 10 times what we entered because we were able to scale out. All right. So the thing to remember here is this led to a $255 option finally closing out at actually $860, right? Oh, sorry, $360, $1.40, $360, $1.40, and $2.50. There we go. So what we want to remember is that if we have a great trend and we have scalability, we can scale out of trends and not get flat. All right, so if you're new to trading, what I'm hoping you're seeing is that ETFs are going to do a lot of the heavy lifting for you because they're pre-curated watch lists. They're in many instances, you're guaranteed a certain amount of attention because of the continuing growing popularity of the passive investing universe. All right. So if you're new to trading and you use ETFs as the anchor, your learning curve is going to be cut down unbelievably because, well, I've done the trial and error. ETFs are doing the heavy lifting. And through decades of using these, 12 years now, and decades of using the indicators that I'm showing you, you've got a plan in front of you. I hope you're seeing some of this plan at work as we're going through these examples. ETFs often offer much less risk than individual stocks or even their futures counterparts. You're going to be starting off with these tools, meaning you've got the Darvis, reading, automating support and resistance, propulsion dots being the accelerator, pedal to the market, right? You see when the markets are accelerating and when that accelerating is we start to see the deceleration. And here's the most important thing. You haven't developed bad habits, right? I envy you all that are starting off like this because you're not developing, there's no bad habits to unlearn, right? So, the truth of the matter is this works for me, but you might say, Ron, you've been doing this for 30 years. True. But what you're going to see throughout the next few slides are a lot of members who are doing a lot of what I'm showing you right now and how much it's been helping their trading. Because look, good for you, Rog, but is it going to work for me? Yeah. Now, what if you have a small account? You don't need a lot of capital because the cost of the options are quite low. Think of the average cost of the options that I shared with you in this presentation, typically well under $4 to $5, but scalable. So if you want to buy 2 or 22, you can. These principles apply to any account size. This is not just about small account trading, but small account friendly. This is not just about 6-figure account trading, but you could do it, right? These strategies do not change with the size of your account, the amount of your capital. The only difference between a $2,500 account and a $250,000 account is the number of contracts you're trading. And, in the beginning, 2 or 3 is all you really need to start to see this work for you. So if you have a small account, no problem. This process of using ETFs not only as an analysis tool, which it really is, and as a tool to trade the markets, you can do both. All right. So what if you've been trading for years, like I was, right? It did the same thing for me that it will do for you. It's your ability now to start taking your trading to the next level because the tools we use do not need to replace any of the tools that you already have. If you're an experienced trader, you've been trading for years, you probably already have some favorite tools, okay? But knowing when those tools are going to be more accurate, it's like having a caddy tell you which club is going to be the best one for that shot, right? That's what these tools really are. You'll learn that you don't have to risk a lot of capital to succeed. Steady growth is absolutely possible, and you don't have to be frustrated by endless scanning and looking at names you've never looked at before. They might be disconnected to the market or they're meme stocks or whatever. That frustration's gone. All right. So again, good for you, Rog. I'm glad it's working for you, but will it work for me? Right. When people tell me they're digging out of psychological pits, or people have been telling me they've been trading for 40 years, they never knew what the heck they were doing. And then they realize, oh, okay, this process works. I came with a certain set of skills, and now I can really use them to maximum capacity. That's always awesome for me to watch. And to be a part of that is, why I do what I do. All right. So again, this isn't just me showing you, hey, this is what I've been doing for 30 years and it's been working for me. This is working for folks who have far less experience, far smaller accounts, even larger accounts. Okay. How is it coming together for them? Right. And yes, sometimes we're going to have really big weeks, sometimes, right? But it's really those singles and doubles that I love, right? We just do this consistently, right? And if we're wrong, which we will be, right? If we're wrong, it's not going to put us out of business. I've never blown up an account, not because I've not had losers, but because I understand the math behind the positioning. I understand using ETFs, keeping costs low, scaling in. That's the way we do it. All right. So, ultimately, when we know what all the moving parts are, and we can put it together, it's going to make it a whole lot easier for us to be able to look at the markets and understand, not be driven by the fear-mongering media or analysis that we don't quite understand. We'll be able to see for ourselves, because at the end of the day, and I truly mean this, your P&L can and should look like an uptrend. I love the uptrend in my P&L. It's my favorite uptrend on any chart. It's not dramatic. It's not straight up, right? It's just steady, arguably boring, but it's the most boring, gorgeous uptrend that I try to cultivate, right? ETFs are going to help you get there. I can say that with so much confidence. And I hope you see from these examples, oh yeah, this is dissecting in the market in a way that I really never thought of before, okay? So you know what this means. We are going to we're putting together a class that's going to be covering everything you need to change the way you trade to get these consistent kinds of profits. All right. So we're doing this on October 16. All right. Now, as always, we've got 3 packages for you. And if it's cool with you guys, let me dive into what is in each package. All right. So you can decide what is best for you. All right. Now, first of all, I do want to mention all the indicators that I pointed out during the presentation. They're included. So let's get the indicator question out of the way. All those indicators are included that I showed you: propulsion, wave, grab, Darvis, JT multi. Okay. We're going to get together for classroom time. The strategy class is where we're going to take that deep dive into the principles that I shared with you that created these kinds of trades and the resources that you need to understand the ETFs. And I got to tell you, right now, with the way the market is shifting, I love that we're doing this in a market that isn't going straight up. Because if you can learn to read this market, my gosh, this is going to be sort of the foundation for everything you do for the rest of your career. Because if you can handle this, you can handle anything. In order to really deep dive what we're talking about tonight, and we're going to take 4 hours Q&A together. We're going to cover all the different tools, how to use them, the strategies on the 16th, right? 4-hour class. And then you're also going to get, all right, and this is going to be free with every package. The basic package is going to include for free the EMA wave, grab candles, propulsion dot, the Darvis 3.0, which includes those little arrows that some folks were asking me about, and the JT multi, which is so important because the environment that we're in is going to dictate the indicators we use and the strategies we use. All right. So those are going to be coming free with the packages. Now, if you don't know how to set up the indicators, one of the cool things we do, especially for those of you that are on Thinkorswim, TOS, right, is as well as having the session, the pre-recorded session with Duncan, walking you through it, I'm going to give you the shared file. So you can just open up that shared file on your TOS, and you'll have the exact layout that I use, that you see me use in the live trading. All right. Okay. So again, the setup will be very simple. I love that you guys will understand how to set them up. That pre-recorded session with Duncan will take care of it, but you'll also have the shared file. If you can't make the class, no worries, because the strategy class is recorded. It's going to be part of your personal library. You can review it at your convenience. So that's super important, because 4 hours, it's a lot of material. You can go back later on and review the parts of the class that need more reviewing. Okay, that brings us to the pro package. Okay, now we're going to add 2 days of live trading. So you're going to have the 4-hour strategy class, those indicators that I mentioned for free, that bonus session with Duncan, as well as I'm going to give you that shared file. So the setup on the indicators on your charts is easy peasy. And then we're going to add 2 days of live trading, right? So now this is when you get to sit with me and we set up the trades live and I alert them to you, right? The live trading days are Monday, October 25 and Monday, November 1. Now, look at the split there in the way that this is structured. Because of the way we put together the live trading sessions, that means we're going to be together for 2 weeks, right? We get together on Monday, we game plan the week, and then anything that happens during the course of those 2 weeks, I'm going to send out as alerts. So we get 2 weeks of practicing our new skills, 2 weeks of looking for trading setups, right? And of course, I can't promise that, but typically you end up paying for the class with the trades, hopefully a whole lot more. But remember, you're going to be with me for 2 weeks. We game plan everything Monday. And then because you're getting alerts, you're going to get all the alerts throughout those 2 weeks. And if the markets are going to continue the way they are right now, this is going to be unbelievably invaluable. It's the next best thing to being parked here in my office trading with me. So of course, again, all the indicators are included free, the 34 email wave, the grab, the propulsion, the Darvis, the JT multi, the tech session. Okay. These are the pro trading days. So go ahead and highlight your calendar for those. That way you can join me for the live trading. If you can't join me live, it is recorded. And of course, we're sending alerts. So let's say you can't join all those hours, you're still going to get the alerts to your phone. And the way that I alert is a very different thing. Now remember, you're going to get the free real-time alerts. So when they happen, ding, your phone's going to buzz. It's going to let you know that I'm doing something. But even better than that, the way that I alert is not that I got filled in a trade. It's we're looking for a trade to happen here in this market with these options. So you have some time to take a look at it. And then it's followed up by a fill alert. So if you're worried about, gosh, Rod, I don't know that I can make all these decisions on the phone, or I don't know that I can make these decisions on the fly, you won't have to. That is not the way that I send alerts or trade, quite frankly. So again, can't make the class. It's recorded, part of the library. All right, now we get to the elite package. I'm super stoked about this one because this is basically you hanging out with me in my office for 4 weeks. Every Monday, we get together like a think tank, right? And we game plan the week. So we've got the 25th of October, November 1st, November 8th, November 15th, right? And so for those 4 weeks, you're going to know exactly what I'm doing. So in the elite package, you get you get the 4-hour strategy class, you get the recording of the class. And if you can't be there, of course, you can watch the recording later. The free indicators, again, wave, grab, propulsion, Darvis, JT multi, the tech session, and then 4 days, 4 sessions with me. All right. Stretched out over the course of 4 weeks. I love doing live trading this way because we just get more time together. We get to see more market action together. So with this elite package, again, getting together 4 Mondays in a row, we'll be basically spending an entire month together. Again, no promises, but commonly with that kind of time, sky's the limit. We're looking to maximize whatever we can do with this market, get your investment in the class back. All right. So again, they're given this time gives you time to practice your skills, ask me questions in this live environment. So if you're thinking, Rog, is the market doing that thing from the class right now? We can say, yeah, it really is. And maybe there's a trade to be had there, right? We put our skills and we work together. Again, no guarantee, but it's very often we do exceedingly well given this kind of 1 month together. All right. So again, free with that package, all the indicators that I showed you before, propulsion, wave, grab, Darvis, JT multi, the tech session. And so these are the 4 days of live trading. And then again, even more importantly, in some ways, you get the alerts. All right. And a lot of times when I send alerts, I'm not just going to send alerts throughout that period of time, I like to include chart images so you can see what we're looking at. It's very often that I'll include, say, a bonus video if something's happening midweek and there's something I want to alert you to before we meet again for our session the following Monday. It's not, it's that's the way I'll communicate what's happening throughout those weeks together. All right. So again, choose the package you want, whatever fits your schedule, whatever's going to fit your needs. Again, remember the indicators come with every single one of these packages. JT Multi, Darvis, Wave Grab, Propulsion, all right? And the PayPal credit's a really nice feature. Always good to be able to allow folks to pay in whatever way they're comfortable with. Again, Basic, Pro, Elite. Basic is the class. All the indicators. Pro is the class. All the indicators that we talked about and live trading. And then Elite, heck, that's 4 weeks of hanging out with me. All right. Keep the coffee going. That's all I can say. Caffeinate and dominate. So, what are we talking about when we talk about ETFs? ETFs are going to continue to become, either you learn what they're doing now or later on you're going to be affected by them because they are the most influential corner of the market. So let's dive into some questions here. All right. I am so stoked. And I'll tell you what, I was excited anyways, but with the way that the markets are behaving, I'm more excited than ever to be doing the live trading in this class at this time, because let's face it, the market just isn't making higher highs anymore. Can we buy dips? Yes. Can we sell rips? Absolutely. Can we play chop? 100%. Okay, we absolutely can. All right, so let me answer some questions. Now, I do want to mention something. What indicators are included? JT Multi, Propulsion, Darvis, the upgraded Darvis 3.0, Wave, and Grab. Those are the indicators that are included. Some of you might have some of my other premium indicators, and if you do, that's fine. You don't necessarily need them for this class, but if you have them, like the V-score, bring it. But that's not necessary nor included with the class. Okay. All right. So let me jump into some of these questions, and I'm going to scroll back up. And thank you, as always, for being here with me. I hope that some of the tactics or things you can put to work tomorrow, right away. Okay, Rag, it's time to look at some of these ETFs. All right. So first question here is, what are those small arrows? Yeah, the arrows you saw on the price chart are the Darvis 3.0, indicating a specific pattern that is a precursor to the Darvis box, and it's included for free with the class. Can I please plot a bar chart of your trades by duration? I happen to think the shorter term trades are better in this environment. Dan, I absolutely agree with you. And you bring up a really good point. So our shorter term time frame trades, really good. So let me describe what a typical day is for me, Dan. And some of you have taken my day trading class, right? Many of you actually have, right? I can see so many of the names here. This is sort of the bookend of my trading day. In other words, I day trade the first 2 hours of the day. And the last 2 hours a day, last maybe 2.5 hours a day, I'll look at longer term setups in the way that I'm describing. So what you have is the sort of, in many ways, this would be sort of the class that I would say, if you took the day trading playbook, this is the remainder of my day, right? This is what I do with the longer term time frame. So I'm with you. I love the short term stuff. I love the idea of finding trends also that I can take overnight. And that's the kind of trading that I like to do via options on ETFs or via options in individual stocks. And we will be looking at individual stocks as well, but through that paradigm of their weighting within the ETF and their sympathy to the movements in the ETF. So thank you for the question. Thank you very much. All right, next up. Is the URA chart. Oh, by the way, yes. I mean, if you're going to look at some charts tomorrow, yeah, I love for when you guys take some of the ideas in these classes and just put them to work even before we start the class next Saturday. So, Rog, that thing you taught me in that webinar, it's already working. Yeah, I got to sign up for that class. What is a grab candle? George, a grab candle, grab is an acronym, green, red, and blue. So a grab candle is a color-coded candle that tells us whether a market's bullish, whether it's neutral, or whether it's bearish. And really simply, green is bullish, blue is neutral, red is bearish. Okay? All right. So am I always taking the same number of contracts every time there's a pullback? Clarity, wonderful question. One of the things that we're going to dive into is not just an emphasis on exits in this class, but position sizing is so big. The way that we scale in is unique. It's not something you're going to see a lot of. I don't believe there's a single magical level that we enter at. I believe there's a zone, and the indicators tell me where that zone could be. So am I always using the same number of contracts? No, actually, we use a budget. And if you've never dove into actionable position sizing, which is going to be a part of this class, I mean, it has to be. It's definitely going to be a part of live trading. If you've never done that, looked at the market through the paradigm of a budget, meaning how many dollars am I going to spend? It's going to absolutely change the way you trade. And it's the main reason I've never blown up an account, because of understanding budget and the ramifications of risking a certain amount of that budget per trade. Can I show us how we use what my alerts look like? KR, so what I can describe them. I don't think I have one handy, but what they do is they spell out that they're an alert. They tell you if to buy, what the strike is, what the expiration is, obviously what the symbol is, and then the specific price levels that I want you to enter at. In other words, they're not after the fact fills. There's nothing wrong with that. But it's not the way that I trade, right? The way that I trade is I give myself an alert. I want to know what I want to do at a specific price level. And what I'll teach you to do in the class and in live trading is, how do you use your charting platform to become your trading partner? I mean, I don't want to be glued to the screen all the time, right? There are times I'm going to have to step away from the screen. I'd like to go see the James Bond movie on Friday. And I've actually been in the movie theater or at lunch with my husband, and my alerts go off. And because I already know what I want to buy and the price I want to buy it, it's not unusual for me to put my trades in on my phone because I've already done the homework. The alert goes off, I've got my trade set up. So let's say you're starting with 10K. How do I know how many contracts? So KR, it's kind of the same question as Clarity's. It's a budget. So when I was showing you all the Wingman tracker earlier, my trades, those trades were primarily a budget of spending less than $3,000 per trade. So $3,000 worth of options. Now, I'm not going to say that's what everybody should do. Sometimes I'm closer to $10,000 to $12,000, but it depends on your account size and risk. All right. Okay. Next up is there a constant relationship? Hey there, John. Is there a constant relationship between ETF and the corresponding futures contract? Very much so. Yes. The only time you're going to notice huge discrepancies is during contract rollover. We recently had one with the bonds and TLT. So when we have futures contract rollover and there's a contract gap in the contract between, say, September and December, that kind of thing, there may be gaps you won't see on the ETF that you will see on the futures contract at the same scale. But yeah, there's a very constant connection, right? As far as notional value goes, we can talk more about notional value in the class, but yeah, it's not necessarily like you can look at the contract of YM and know how many dollars, right, notional value that it is. But I'm not really looking to get you guys to match up the notional value because pursuit of that could present too much risk. So I'm really focusing on the budget and the risk that buying options on DIA or even, the futures contracts. This would work for futures contracts options too. I just like to focus on the ETF, right? So we focus on budget, right? Not trying to match up notional value, but thank you. That's a great question. Please define end of day, 4 p.m. Eastern, Andrew, 4 p.m. Eastern. What are the green and white arrows? That is the Darvis 3.0 Kumars that is free with all 3 levels of the class. Does it work on short-term time frames? Absolutely. Yeah, while this is not a day trading class, I would say the processes of building a watch list, finding trends. I mean, frankly, whether you're trading a daily time frame, a weekly time frame, or a 1-minute time frame, the answer is absolutely yes. Yeah. Because again, why is that? Because the way that I've designed my trading life, and big thanks to my mentors early on, they said, Rag, if what you're doing, generally speaking, does not work universally and robustly, works on everything and works well, you really just curve fitted an approach. And I took that to heart. So, there might be some nuances from my day trading, meaning time, to this, but I use the same tools, and you'll see that consistency across all my charts. All right. Okay. So next question. And if you have questions about having bought an existing package or a bundle, please just contact the office. They will help you out. Okay. So if you've bought something else, or you have a question about the package, or you've already got certain indicators, ask the office, call them up. They are happy to help you out. All right. What is my typical options expiration time frame? George, nothing is worse than being a directional debit trader, which I am. I'm 95% long call and long puts. I'm not a complex carbohydrate of an options trader. I keep it ridiculously simple. But there is the mortal enemy of every long position in calls or puts, and that is theta decay, right? So yeah, I do need to keep a certain distance from theta decay, and remembering that theta decay accelerates inside of 21 days, we like to keep it at least 2 times that minimally, okay? Is propulsion similar to momentum? Mojo, no. They might be measuring and looking for something similar, but no, it's not the same thing. But if you have it already, if you have a momentum, it will work really well. Like I said, none of the indicators that I'm mentioning really should have to supplant anything you already have. It's more like a caddy telling you which club to use for the shot. Really, that's what it is. It's a supplement. It doesn't have to replace anything that you love already. Okay. Which indicators are free and which are paid? SD, what is coming, Andrew, what is coming with this class is Darvis 3.0, Wave, Grab, Propulsion, and the JT Multi. Now, many of you might have Wave and Grab and Propulsion. The JT Multi has been available pretty much only in classes, and the Darvis 3.0 is a premium indicator that so far is either available only in the bundle or in my classes. Okay. All right. Next up is the daily time frame is used in these examples. Do I use multiple time frames? William, I actually don't have to, but here's a cool thing. If you want to, let's say you want to confirm a daily with a 1 hour, or let's say you want to confirm with a 240, you can put these same indicators, this same process to work on those time frames. So I'm definitely not here to tell you you can't. I'm just here to tell you you really don't have to. And so the flexibility, the choice is yours. It can work. If you say, Rog, I don't know about daily time frames, but I love trading 240s or 30-minute or 60-minute charts. Will this work? Yeah, absolutely. It's just structure on a different time frame. We're still looking for the same things. The watch list will be built the same way. All right. What is the typical duration? Great question, AJ. I'd say 2 to 3 days to 2 to 3 weeks. And really, the deciding factor is proximity to expiration. I mean, I'll give you a great example. I'm in UNG right now. My biggest problem with UNG is that I'm going to be quickly running out of time. We're in that natural gas long that has been going parabolic. And my biggest problem is that. Yeah, that's so in some situations, I'm just going to run out of time, even though I've been in it for, gosh, the better part of 6 weeks, I guess now. I use TradingView a lot. Those of you that join me for Charts and Coffee have seen that. And yes, most of the indicators, actually all of the indicators in this class are available for TradingView. So if you like TradingView and TOS, as do I, yes, the indicators are available for TradingView as well. All right. Okay, so yes, Darvis 3.0 is the arrow signal. Sector rotation, George, it's really understanding the weighting of the sectors and the indices and the way that they're interacting. I use a Ferris wheel analogy, what's the top, what's the bottom, and I look at the relationship those sectors have to one another. And I use some pretty cool software that's free to do it. And I'll be walking through that in the class and in the live trading quite a bit. The live trading, of course, is going to be trading, but the live trading allows us to revisit the topics of the class and really expound upon them, dive into them, because we have so much more time, right? Okay, so let's see. I'm doing well. Thank you, Stephen. I would like to know what times you're finding that you are most active during the day. So if I'm day trading, 9:30 to 11:30 Eastern. And if I am doing the kind of trading that I'm going to teach you in this class, I'll tell you straight out, you don't have to be at your desk for this. This experiment started with, in many ways, Trish, she's my partner in the office. Many of you know who Trish is. Saying, look, Raghee, you wrote a book called 5 Hours a Week, kind of trading on 5 hours a week. Can you really only spend an hour a day in the market? I said, yeah, especially if it's an end of day daily time frame. So the idea here is, if I'm doing my homework, much like Nicholas Darvis did, after the market closes or before it opens, and I know which levels I want to engage a market at, all I then need to do is use my trading platform, my charting platform, as my set of eyes. And when those certain prices are reached, I just have to buy that predetermined option that will allow me to take the trade. So I don't recommend it necessarily, but it absolutely can be done. Just the homework is going to have to be done either before the open or after the open, or whatever your time is. You're going to need about 30 to 60 minutes, and to set those alerts, to make sure you're prepared for the coming trading day, so that if the levels that you're looking to act at are reached, you're notified by your trading partner, which is really your charting or trading platform. So yes, I think it works for any schedule, not day trading though, but the type of trading that I'm going to teach you, absolutely. Okay. All right. What about the V-score indicator? Not necessary for this class, but if you have it, feel free to bring it with you. Okay. But it's not included, nor is it necessary for the class. All right. Let's see. So if you have the indicators in the day trading class, yeah, you're all set. Yeah, 2 weeks or 4 weeks. Hey there, Liza. How are you, my friend? Yep, 2 or 4 weeks. You got it. Let's see what else we have. This is nothing like the day trading class. Although, like I like to say, this is the bookend to it. You know what I do in the morning now. Now, this is how I trade in the afternoon. This is how I find longer term entries. This is how we trade the daily time frame, take overnight trades, as opposed to looking at 2 and 5 minute charts and taking short-term time frames. Now, if you took the day trading class, cool. You're already an elite operator at understanding order flow, order entry, intraday nuance. Now you get to take that same knowledge into the afternoon, and the way that you execute the trades from this particular strategy, from this class, are just going to be better. It's just going to be stronger, better, because you have that knowledge. So they're very hand in glove, but they're peanut butter and jelly, right? They're two different things, but you bring them together, you got a heck of a sandwich. All right. So as far as questions about how, if you already have indicators or so forth, if you have questions about the package, feel free to call 512-266-8659. As far as, Rag, I have your indicators, or Rag, I have this, and, what can the office do? Give them a call, okay? They will help you out. All right, so let's see here. Anything else that I didn't? Well, Kara, are these the same strategies that I use in the Sector Secrets? Yeah, they actually are. They absolutely are. So if you're in my mastery, this is a deep dive into what I do in the mastery. This is a deep dive class dedicated to that, right? If you're interested in the mastery, you're going to get a great heads up. You're going to get a great jump start to when eventually you do join that, because this is This is the strategy, yeah, that we use for a lot of those trades. Absolutely. And then, like I said, what gets me really excited about the timing of this? Look, there's no way we can plan this. I didn't know that we were going to have Evergrande, monetary policy, a Fed trading scandal, and all sorts of other shenanigans take this trend that we've been riding for much of the year and turn it into a choppy mess. And yet, this is such a great opportunity to take a class. You ever watch, sometimes Discovery Channel does these specials on Navy SEALs, they take them through Hell Week, right? Hell Week happens about, I don't know, halfway through BUDS. I don't know when it happens, not a Navy SEAL, but this is kind of a very cool opportunity to go through Hell Week. And I remember there was one of the specials my husband and I were watching, and they were talking to one of the guys. I mean, they just run them ragged. You know how it is. And they said, "Why do you do this?" And the guy looked up at the camera. He's exhausted. He's starving. I don't think his eyes were going in the same direction. And he looked at the camera and he said, was it seven days of hell for a lifetime of pride? I thought, wow, how cool is that? If we can put ourselves through difficult markets, there's no uptrend or downtrend that's going to be difficult for us to trade if we can handle the chaos and the uncertainty of chop. That's the Hell Week. So indirectly, we've got this great Hell Week we get to use. And yeah, you can trade chop. Those of you that have been following me for a while, I've been buying a choppy RTY on and off for the last couple of months. That's a choppy market. Yeah, so there are choppy strategies we can use. We just transition to them once the tools tell us we're there. And that's really what it's going to do for us in a huge way. Okay. So I'm looking at basic. So the question was, do I do things like butterflies, straddles, etc.? Look, here's the thing. If you can buy a long call, right? If you can get long a call, if you can get long a put, you've got the building blocks to any multi-leg strategy that you may want to pursue in your career. But I'll tell you this, like I said, 3 decades in, what I'm doing is simplifying. But if you want a better way to build calendar straddles, diagonals, butterflies, the timing that I'm going to teach you is going to apply to every kind of multi-leg strategy that you're going to execute, whether that's call verticals, whether that's put credit spreads. The zones that I'm going to teach you will apply to them. And we'll definitely get into that in the class, and most definitely in live trading, where, if I'm buying a long call, it's interesting how often that might be a call vertical opportunity or even a put credit spread in that same zone with that same structure. So they do overlap. Absolutely. All right. So it's about 9:30 here. I know a lot of you have been with me for about an hour and a half. Thank you so much for your time. Thank you for the questions. I am very looking forward to seeing everybody the 16th. Keep an eye on some of the tactics that I've already mentioned in this webinar. They're already going to move the needle for you. So just imagine what Saturday is going to do. Looking forward to it. Be good to each other. I'll talk with you all soon, and I'll see you on the 16th.